Imagine you are standing at the edge of basically the biggest gold rush in human history. I mean, the ground is shaking, everyone is rushing in, and there are just billions of dollars flying around.
Oh, absolutely. Total chaos.
Right. And most people, they get completely obsessed with the miners, like the folks actually pulling the raw gold out of the dirt.
Which is the obvious play, sure.
Exactly. And then some of the smarter people are looking at the guys selling the pickaxes and the shovels, but then you realize there is someone else entirely.
Sitting right in the background.
Sitting entirely behind the scenes. They aren't selling the pickaxes. They are selling essentially the fundamental laws of physics and the blueprints you need to even conceive of a pickaxe in the first place.
Right. If you want to dig, you have to pay them a toll first. No way around it.
It is the ultimate bottleneck. And welcome to this Talk Tickers Deep Dive, by the way. Today we are looking at the Q2 2026 earnings call for Synopsys. Ticker symbol is SNPS.
Yeah, and this isn't just another software company. This is the inescapable toll booth on the highway to the whole future of computing.
And you literally cannot bypass them if you want to play in the AI economy. So our mission today for you, the retail investor, is to just strip away the noise.
We're going to look at the raw data that CEO Sassine Ghazi and CFO Sheila Glazer just delivered.
Exactly. Data forward, translating the Wall Street jargon into plain English and making it actionable. So let's jump right into the scoreboard.
Gotta know where they stand before we figure out where they're going.
Right. So total revenue for the quarter came in at $2.276 billion, which is a really solid beat on expectations.
A very healthy beat, yeah.
And non-GAAP earnings per share hit $3.35. Non-GAAP operating margin was incredibly strong at 39.5%. Oh, and they generated $575 million in free cash flow.
Those numbers are just massive. I mean, especially when you put them in the context of the sheer scale and the operational complexity of what the business is actually doing right now.
Well, I want to stop you right there on that non-GAAP metric, because we see this all the time in tech earnings.
Oh, constantly.
Yeah, and I think it's really easy for retail investors to just gloss over it. When Sheila Glazer points to that 39.5% non-GAAP operating margin, what is she actually asking us to ignore?
That's the billion-dollar question.
Because GAAP generally accepted accounting principles. That is the standardized math. That's the law of the land. So when management says, look at the non-GAAP numbers, there's always a reason.
There is. And look, in this specific case, it's actually a highly legitimate reason.
Okay, lay it out for me.
So when we talk about GAAP versus non-GAAP, we are usually talking about stripping out expenses that don't really reflect the underlying day-to-day health of the core business.
Right.
And for Synopsys right now, the single biggest distortion in their GAAP numbers is the lingering financial shockwave from their ANSYS acquisition.
Right, because buying a multi-billion-dollar company isn't just, writing a giant check.
Not at all. I mean, the frictional costs of a mega merger are just staggering. You've got massive legal fees, advisory fees.
Severance packages for redundant executives, I imagine.
Exactly. Severance is huge. Plus the cost of breaking commercial real estate leases. Because, you don't need two separate headquarters buildings in the exact same city anymore.
Right.
And you have the amortization of intangible assets. So under strict GAAP accounting, all of those one-time costs just get slammed onto the income statement.
Which makes the company look significantly less profitable than it actually is on a day-to-day basis.
Precisely. If you are trying to value the ongoing perpetual cash generation machine that is Synopsys, you really shouldn't penalize them indefinitely for the one-time cost of integrating a new subsidiary.
Okay, that makes total sense. So if we look at that 39.5% non-GAAP operating margin, that is the number that actually matters for long-term valuation.
It is. And frankly, in the enterprise software world, pushing a 40% operating margin is elite territory.
It's massive.
It means for every dollar that comes in the door, almost 40 cents is pure operating profit before interest and taxes. It demonstrates immense pricing power.
Okay, but I want to push back on this whole narrative of invincibility for a second.
Bring it on.
Because as I was combing through this transcript, looking past that headline revenue beat, I found a metric that made me genuinely worried.
The backlog.
Yes, the backlog. They announced that their remaining performance obligations, their backlog of guaranteed future revenue, ended the quarter at $11 billion.
Which, to be fair, is a massive number.
It is, but it's a sequential decline.
Yeah.
It actually dropped quarter over quarter.
It did.
And in almost any other software as a service company in the world, if you see the backlog shrinking, it means customers are fleeing or churn is spiking.
Right, or sales have just hit a brick wall.
Exactly. Wall Street usually brutally punishes SaaS stocks for a declining backlog. So why isn't the market panicking over this? Like, why didn't the stock just crater?
It's a completely fair concern. And honestly, it's exactly the kind of metric that trips up investors who try to take standard consumer software metrics and apply them to the semiconductor industry.
So walk me through it. Because if guaranteed money is going down, I need to know why that isn't a massive red flag for my portfolio.
Okay, think about the customers we are dealing with here. We are talking about NVIDIA, AMD, Apple, Google.
The Titans.
Exactly. These companies do not log onto a website and buy a monthly pay-as-you-go subscription to Synopsys using a corporate credit card.
Obviously not.
Right. They engage in negotiations that take months, and those result in massive multi-year, multi-$100 million contractual commitments.
Okay, I'm with you.
Now, let's say Apple signs a massive 3-year enterprise licensing agreement today. Accounting rules dictate that the entire value of that 3-year contract gets dumped into the backlog bucket all at once.
Oh, wow. All at once.
Yep. So in the quarter that contract is signed, the backlog spikes artificially high. But Synopsys cannot recognize all that revenue today because they haven't actually delivered 3 years of service yet.
Right. Basic revenue recognition rules, they have to slowly bleed it out over the life of the contract.
Exactly. So over the next 11 or 12 quarters, Synopsys slowly recognizes that revenue on the income statement, which means they are steadily burning down that backlog bucket. Enterprise software is incredibly lumpy. You have quarters where a cluster of massive multi-year renewals all hit at the exact same time. Those are what we call build quarters. The backlog explodes.
And then you have multiple quarters in between where very few mega contracts are structurally up for renewal.
Right, those are burn quarters. The backlog organically declines simply because they are delivering the software they already sold.
Oh, I see. So a sequential decline from Q1 to Q2 doesn't mean Google or NVIDIA canceled their contracts.
Not at all.
It just means Q2 happened to be a quarter where fewer of those massive 3-year deals were up for their normal renewal cycle.
That's exactly what CFO Sheila Glazer was communicating when she called it the normal ebb and flow of the business. You have to look at the overall trajectory of the revenue and the structural demand.
Not just a quarter-to-quarter fluctuation.
Right. You can't panic over a metric designed for a different type of software model.
Okay, and if we look at that structural demand, that is where this story gets totally wild.
Oh, it really does.
Because if the backlog is naturally burning down, the question for you as an investor is, well, what is the actual catalyst that will build it back up in the coming quarters?
Who is buying this stuff right now and why?
Exactly. Which brings us to their design automation segment, the EDA software, which grew over 8% year over year.
And look, 8% might not sound like hypergrowth to a retail investor who's used to looking at early stage tech startups.
Right, it's not 50% growth.
No, but for a highly mature software segment operating at this kind of massive scale, an 8% absolute dollar growth is a staggering influx of cash.
So to understand why it's growing, we have to look at the fundamental shift happening in the global silicon market, specifically driven by the AI boom.
Let's define the terms first.
Good idea. EDA, electronic design automation.
Right. It is the software used to actually design computer chips. I mean, we are well past the era where engineers could just sit at a drafting table with a pencil and draw the circuitry for a processor.
Oh, we are decades past that.
Decades. Modern chips have billions, sometimes tens of billions of microscopic transistors crammed onto a piece of silicon the size of a postage stamp.
Which is just mind-blowing to even think about.
It's physically impossible for the human brain to comprehend the routing of those wires, let alone ensure they don't, electromagnetically interfere with each other or just melt.
So EDA is essentially physics-defying software that allows human engineers to orchestrate billions of microscopic connections.
Exactly.
But who is actually buying it? Because traditionally, if a big tech company, say a hyperscaler like Google or Microsoft or Amazon, if they wanted to build a massive data center, they didn't design chips.
No, they didn't. They went to a merchant chip maker.
Right. Historically, the model was based on what we call merchant silicon. You went to Intel or AMD or Broadcom, and you just bought off-the-shelf general-purpose processors.
So if I'm Google 5 years ago, I'm just buying whatever Intel is selling and racking it in my servers.
Right. So why has that changed?
Because of the computational and energy demands of artificial intelligence, specifically large language models.
the chat GPTs of the world.
Exactly. When you are training a model with 1 trillion parameters, the mathematics required are incredibly specific, and the energy consumption is just astronomically high.
And general-purpose chips can't handle that efficiently.
Well, off-the-shelf chips are designed to be pretty good at a wide variety of tasks. But because they are general purpose, they carry a lot of extra architectural baggage. That baggage wastes electricity, and it slows down specific AI calculations.
So the hyperscalers basically realized the merchant silicon model was financially unsustainable for the AI era.
Exactly. A company like Google or Amazon looks at their power bill and they look at the performance bottlenecks and they realize, wait, if we design our own custom chips from scratch, chips that are surgically optimized to do exactly one thing, which is run our specific AI models, we can save billions in electricity.
And gain a massive performance edge over their competitors.
Exactly.
It's kind of like the difference between buying a really reliable minivan off the lot because you need to drive to the grocery store,
right,
versus deciding you need to win the Formula One championship, so you hire a team of engineers to build a custom race car from scratch. I mean, the minivan won't win the race, and it wastes way too much gas going 200 miles an hour.
That is a perfect analogy. The hyperscalers are building custom Formula One cars. They call it custom ASIC development. Application-specific integrated circuits.
So Google has the TPU?
Yep. Amazon has Trainium and Inferentia. Microsoft has Maya.
But here's the catch, right? These companies are historically software and cloud infrastructure companies. They don't inherently know how to design silicon at the microscopic level.
And that is the exact bottleneck where Synopsys sits. If a hyperscaler wants to build a custom AI chip, they absolutely must license the EDA software from Synopsys to do it.
They have no choice.
None. Synopsys provides the digital architecture, the testing environments, the simulation tools. The hyperscaler engineers bring the specific AI logic they want to execute, but Synopsys provides the physics engine that makes it actually possible to manufacture.
Which perfectly explains why EDA growth is re-accelerating. Every major tech company in the world is suddenly spinning up their own internal silicon design teams.
Yep.
But they aren't just buying the software environment to design the chips, they are also buying the raw ingredients. The intellectual property segment.
Which is a crucial piece of this earnings call, because the IP segment was actually a significant point of anxiety for investors last year.
Right. Growth had slowed down. The macro environment was uncertain.
Yeah, and people were really worried the IP business was structurally decaying.
But Sassine Ghazi confirmed on this call that the IP segment officially bottomed out in Q1. And here in Q2, it grew 12% sequentially.
That is a massive, immediate rebound.
It is. And it is being heavily driven by that exact same hyperscaler demand for custom AI silicon we just talked about.
We should probably clarify what IP means in this context.
Yeah, please do. Because to a retail investor, intellectual property usually means like patents or copyrights or a trademark on a logo.
Right. But in the semiconductor supply chain, IP means something very physical.
Okay, what does it mean?
In this world, IP refers to literal, pre-designed, pre-verified blocks of circuitry. Think of them as incredibly complex digital Lego blocks.
Okay, so if Amazon is designing their custom Trainium chip, why are they buying Lego blocks from Synopsys? I mean, shouldn't they just design the whole thing themselves?
Because it is a massive waste of engineering resources. Amazon wants their smartest, most expensive engineers focusing 100% of their brain power on designing the specific AI processing core.
The part of the chip that actually does the neural network math.
Exactly. That is their competitive advantage. They do not want to waste thousands of engineering hours trying to figure out how to connect that processing core to the server's memory bank.
Oh, I see.
Or how to route the data off the chip and onto the motherboard.
So they want to focus on the brain of the chip, but the chip still needs, eyes and ears and a nervous system to actually communicate with the rest of the computer.
Precisely. And connecting a chip to the outside world requires adhering to incredibly strict industry-wide physical standards.
Instead of reinventing the wheel.
Amazon or Google will just go to Synopsys and say, hey, we need the circuit block that handles memory connections, and we need the circuit block that handles high-speed data transfer. Just sell us the blueprints.
And they buy those IP blocks and digitally stitch them onto the edges of their custom AI core.
Exactly.
And the transcript highlighted one IP block in particular that is seeing just explosive demand. PCIe 7.0.
Oh, yeah.
The management team noted they have a greater than 90% win rate for PCIe 7.0 IP. They secured 18 new licenses just in this single quarter.
A 90% win rate is staggering. I mean, that isn't just market leadership. That is basically a functional monopoly on a critical piece of global infrastructure.
So explain PCIe 7.0 to me. Why is everyone buying this specific standard right now?
So PCIe stands for Peripheral Component Interconnect Express. It is the fundamental data pipeline that connects the different processing components inside a computer.
Okay.
If you have an AI chip and it needs to pull terabytes of data from the memory bank to train a model, that data travels over the PCIe lanes.
So it's the plumbing.
It is the plumbing. But in the AI era, the volume of water trying to rush through those pipes is unimaginably large.
Right.
So PCIe 7.0 is the absolute bleeding edge standard for this plumbing. It offers double the bandwidth of the previous generation. It is, for all intents and purposes, the widest, fastest data pipe currently permitted by the laws of physics.
And why can't these tech giants just design their own PCIe 7.0 pipe? Why give Synopsys a 90% market share?
Because mixed signal analog design, which is what high-speed interconnects rely on, is arguably the hardest form of electrical engineering on the planet.
Really?
Oh, without a doubt. When you are pushing data at PCIe 7.0 speeds, you're dealing with extreme signal degradation, electromagnetic interference.
Sounds like a nightmare.
It is, and timing closures that have to be precise down to the picosecond. If your data pipe has even a microscopic flaw, the data gets corrupted. The AI model hallucinates or just crashes, and the whole system fails.
Wow.
Synopsys has spent billions of dollars and decades of research perfecting these interconnect blocks. Their PCIe 7.0 IP is what they call silicon proven.
Meaning it works flawlessly every single time.
Yes. For a hyperscaler, paying Synopsys for that guarantee is absolute pocket change compared to the catastrophic cost of a failed chip launch.
Okay, that makes perfect sense. They own the toll booth for data movement.
Yeah.
But there was some deep jargon in the transcript right after this that I really have to ask you about.
Yeah.
Ghazi was talking about another standard called UCIe. He said they hit over 150 lifetime wins for UCIe, including, and this is a direct quote, a 64 gig tape out on a 2-nanometer process.
Now that is a dense sentence.
It's incredibly dense. Let's break it down, starting with the end of that phrase. What on earth is a 2-nanometer process, and what is a tape out?
Okay.
Because if I'm an investor, I need to know what physical reality these words actually describe.
Let's start with the 2-nanometer process. This refers to the physical manufacturing node at the foundry, places like TSMC in Taiwan.
Okay.
When we say 2 nanometers, we are talking about the physical size of the individual transistors on the silicon wafer.
2 nanometers. Just for context, how small is that?
Well, a strand of human hair is about 80,000 to 100,000 nanometers thick.
What? So we are talking about structures that are approaching the size of individual atoms.
We absolutely are. At 2 nanometers, you are literally dealing with quantum mechanics. You are dealing with electron tunneling, where the insulation between wires is so incredibly thin that electrons can just teleport across the gap and cause short circuits.
If the design isn't absolutely perfect.
Exactly. It is the absolute bleeding edge of human manufacturing capability.
Unreal. And what does tape out mean?
So tape out is an old industrial term from the early days of computing when engineers would actually write the final design of a chip onto magnetic tape, and then they'd physically mail it to the manufacturing plant to be printed.
Literally putting it in the mail.
Yeah. Today, it simply means the final milestone of the design phase. When a chip tapes out, it means the software design is 100% complete, verified, and has been digitally sent to the foundry to be manufactured into physical silicon.
So when management brags about a 2 nanometer tape out, they're basically signaling to Wall Street, look, our software and our IP blocks are capable of designing the most advanced, complex, atom-scale hardware in human history.
And our customers are successfully getting those designs across the finish line.
That is a massive flex.
It proves their technology scales to the absolute limits of physics. But you mentioned UCI as well, and that is where the story actually pivots toward their massive acquisition of ANSYS.
Right, UCIe, Universal Chiplet Interconnect Express.
Yes.
Walk me through this, because my understanding is that the semiconductor industry is fundamentally changing how a chip is actually built. Like, we aren't just making one flat square of silicon anymore, right?
No, we are hitting the physical limits of how large you can make a single monolithic piece of silicon.
Why is that?
Because if a chip gets too big, the chance of a microscopic defect ruining the entire wafer becomes way too high, and your manufacturing yields just plummet.
Okay, so what's the solution?
The industry has shifted to chiplets.
Which means instead of building one massive, sprawling ranch-style house,
Yeah.
you're building a skyscraper.
Exactly. You manufacture smaller individual pieces of silicon chiplets, and you stack them on top of each other in 3 dimensions.
3D IC.
Right, 3-dimensional integrated circuits. It saves space, it decreases the distance data has to travel, and it improves manufacturing yields.
But to make a chip stacked on the second floor communicate instantly with a chip stacked on the 5th floor, you need a specialized elevator shaft.
And that elevator shaft is UCIe.
Boom!
UCIe is the standard protocol for letting stacked chiplets talk to each other vertically. And just like with PCIe 7.0, Synopsys is absolutely dominating the market for the UCI IP blocks.
But stacking chips like a skyscraper introduces a catastrophic new variable, which is what brings us to ANSYS.
Right.
ANSYS contributed $652 million to total revenue in Q2. Synopsys bought them because ANSYS is the undisputed king of multiphysics simulation. So why is multiphysics suddenly the most important thing in the world for chip design?
Because of heat.
Heat.
Think about the physics of that 3D skyscraper we just described. If you have a massive, powerful AI processing core, it generates an immense amount of thermal energy. If it's a traditional flat chip, you can put a heat sink and a fan directly on top of it. But if you take that hot processing core and you physically stack another chip directly on top of it and another chip on top of that, where does the heat go?
It gets trapped inside the stack.
It gets trapped. And if you cannot effectively simulate the thermal dissipation, the fluid dynamics of the microcooling channels, and the structural integrity of that silicon under extreme thermal stress.
Before you manufacture it.
Exactly, before you manufacture it. Otherwise, you are going to waste hundreds of millions of dollars at the foundry producing 3D chips that literally melt themselves from the inside out the moment you turn them on.
Wow. So Synopsys realized, look, we own the software that designs the logic of the chip. But if the industry is moving to 3D stacking, the logic doesn't matter if the physical materials just fail.
We have to own the physics simulation too.
That is the entire thesis behind the ANSYS acquisition.
It is. Synopsys now captures the entire silicon to systems lifecycle. You design the chiplet in Synopsys EDA, you connect it using Synopsys UCI IP, and you simulate the thermal and structural reality of the 3D stack using ANSYS multiphysics software.
You cannot build a next-generation data center without touching all 3 of those tools.
Impossible.
The strategic logic is undeniable, and the revenue contribution in Q2 is massive. But as we promised our listeners, we have to translate the fine print.
Always look at the fine print.
There is an accounting quirk involving ANSYS that CFO Sheila Glazer flagged on this call. And it is exactly the kind of thing that algorithms and casual investors get tripped up by.
This is a vital nuance for anyone building a valuation model for this stock.
Explain this accounting shift to me.
Yeah.
It has to do with how ANSYS historically sold its software through third-party channel partners, right?
Correct. Before the acquisition, ANSYS relied heavily on external sales agencies' channel partners to sell their software globally. Let's say an independent software vendor in Europe sells an ANSYS license to an automotive company. Under ANSYS's old accounting structure, they had limited visibility into that exact end-user transaction.
Right.
So ANSYS would record the revenue on a net basis.
I want to make sure I understand net basis.
Yeah.
Let me use an analogy and you tell me if I'm tracking this correctly.
Go for it.
Let's say I own a vintage jacket and I give it to a local consignment shop to sell for me. The shop sells the jacket to a customer for $100.
Okay.
The shop takes a $20 commission for doing the work, and they hand me a check for $80. Under net basis accounting, I would report my revenue to the IRS as $80. The $20 commission never touches my books. I just retort the net cash I actually received.
That is an excellent analogy. Yes, ANSYS was reporting the $80 as their top-line revenue.
Okay.
But now that Synopsys owns ANSYS, they are integrating those external sales channels into the massive Synopsys global machine. They are getting direct visibility and control over those partner networks.
Right.
Because of this newfound control, GAAP accounting rules suddenly dictate that Synopsys must change the revenue recognition from a net basis to a gross basis.
Okay, so back to my jacket. Under gross basis, I have to report the full $100 the customer paid as my top-line revenue.
Yes.
And then, on the expense side of my ledger, I have to report the $20 commission I paid to the shop as an operating expense.
Exactly right.
But wait, my actual take-home profit is exactly the same. I still only have $80 in my pocket. All that changed is the numbers look bigger on both the revenue line and the expense line.
You've hit the nail on the head, and that is precisely what happened in Q2 for Synopsys. Because of this accounting shift, their top-line revenue was artificially bumped up by $12.5 million.
And their operating expenses were artificially bumped up by the exact same $12.5 million.
Exactly. So it is completely neutral to earnings per share. It is completely neutral to free cash flow.
It's just a mirage.
Basically. The business did not generate an extra $12.5 million in organic growth. They just changed the way the math is presented on the income statement.
The actionable advice for you, the retail investor here, is crucial. When you see that revenue beat, you have to mentally subtract that $12.5 million to understand the true organic top-line trajectory of the combined business.
Do not let a gross revenue classification change fool you into over-modeling their future growth rates.
That is exactly the kind of deep dive transparency we aim for here. Now, moving beyond the operational numbers and the accounting, there was a massive plot twist discussed on this call.
Oh yeah, the activist.
It was delivered almost casually by Sassine Ghazi, but the implications are seismic. The activist angle.
The presence of Elliott Management.
Yes. Ghazi announced an agreement with Elliott Management, placing a man named Jesse Kahn on the Synopsys board of directors as an independent director.
Which is wild.
Now, retail investors who follow the markets know that Elliott Management is arguably the most feared, aggressive, and effective activist investor firm on Wall Street.
They are the apex predators of corporate governance.
But here is what I don't understand, and what I want you to unpack for us. Activist investors usually circle dying companies.
Oh, no, yes.
They buy up a huge chunk of a distressed, mismanaged company. They force their way onto the board. They fire the CEO. They sell off the bad divisions, and they try to squeeze some value out of a failing asset.
That's the standard playbook.
But Synopsys isn't distressed. Synopsys is a monopoly-like toll booth, sitting at the epicenter of the biggest secular growth trend in human history.
Right.
The stock has been on a tear over the last 5 years. Why on earth is an activist investor here? What is Jesse Kuhn's playbook for a company that is already winning?
It's a fascinating dynamic, and you are right to point out how unusual it is. But Sassine Ghazi addressed this directly. He explicitly stated that there was immediate alignment with Elliott Management on the fundamental value of the company.
So they aren't hostile.
Elliott is not there to break Synopsys up. They aren't there to fire Sassine Ghazi. They agree that Synopsys owns the most critical bottleneck in the AI supply chain.
So what do they want?
They want value extraction. Okay. The activist thesis here is essentially this. You guys have the most important physics-defying software on Earth right now. Google, Microsoft, Amazon, and NVIDIA literally cannot build their trillion-dollar future without you. You are utterly indispensable.
Right.
So, why is your operating margin only 39.5%? Why isn't it 45%? And more importantly, why aren't you extracting significantly more dollars from these trillion-dollar hyperscalers?
It's a monetization play. Elliott is looking at the sheer amount of wealth being generated by the AI hardware boom, and they're pointing out that Synopsys isn't capturing its fair share of that value relative to the importance of its tools.
Exactly. Jesse Cohn is in that boardroom for two reasons: aggressive cost discipline and accelerated monetization.
And management seems to be welcoming the pressure, or at least strategically embracing it.
Oh, definitely. On the call, they highlighted that they are significantly accelerating the cost synergies from the ANSYS acquisition.
What does that actually look like in practice?
It means Elliott Management is going to hold their feet to the fire to trim the operational fat. It means aggressively consolidating global real estate footprints.
Right.
It means ruthless integration of the go-to-market sales teams. I mean, if a Synopsys sales rep and an ANSYS sales rep are both calling on the same engineering VP at Ford Motor Company, you fire one of them and give the survivor the combined portfolio.
Makes sense.
It means squeezing third-party vendor contracts. Elliott is there to ensure that as this massive revenue wave continues to roll in, it flows directly down to the bottom line rather than getting soaked up by bloated corporate infrastructure.
Which transitions us perfectly to the guidance for the rest of the year. Because if you have an activist pushing for ruthless profitability, and you have hyperscalers desperately buying your EDA software and your IP blocks to build custom AI chips, what does management actually promise Wall Street they can deliver in the back half of the year?
They raised the roof. They didn't just reaffirm their previous guidance, they increased it across the board.
Which is the ultimate signal of confidence in this macroeconomic environment.
Completely.
Let's look at the new full-year FY26 numbers. Total revenue is now guided up to a range of $9.625 billion to $9.705 billion.
Incredible.
Non-GAAP operating margin is being raised by 50 basis points to an incredible 41%.
Hitting a 41% operating margin on almost $10 billion in revenue is a staggering achievement.
Right.
It speaks directly to that Elliott management influence we just discussed. They are enforcing operational discipline while simultaneously flexing their pricing power.
And the bottom line follows. Full-year EPS is raised to $14.72 to $14.80. Free cash flow for the year is raised to a massive $2 billion.
But just as we did with the Q2 numbers, we have to adjust for the structural noise here. We have to look at the fine print of that revenue raise to understand the organic momentum.
Right, because that revenue bump to $9.6 billion isn't entirely new sales.
Correct. The new guidance includes a $60 million full-year benefit from that ANSYS channel accounting quirk, the gross versus net revenue shift we walked through earlier.
The jacket analogy.
The jacket analogy, exactly. But it also absorbs a significant negative hit. Synopsys is currently in the process of divesting their processor IP solutions business.
Oh, right.
They are selling it off because it's no longer core to their strategy. That divestiture is going to reduce their second half revenue by about $40 million.
Okay, let's do the math on that for everyone. The accounting quirk artificially adds $60 million to the top line. The divestiture structurally subtracts $40 million. So the structural noise nets out to a $20 million benefit to the guidance.
Exactly. But management raised the overall full-year revenue guidance by $35 million at the midpoint.
Which means, even after you strip out all the accounting illusions and the divestitures, the core organic business is accelerating faster than they previously modeled.
The demand is undeniably real.
It is. But if we were talking about demand and future revenue, we have to talk about the most crucial, paradigm-shifting moment of this entire earnings call.
Oh, the Q&A session.
Yes. It happened during the analyst Q&A. An analyst asked a question regarding the activist thesis like how Synopsys actually plans to capture more value and drive monetization in the future.
Right.
And Sassine Ghazi detailed a structural shift in their business model surrounding a technology they are calling Agentic AI.
This is the focal point for any long-term investor. If you are holding this stock for the next 5 years, this is the thesis.
Okay, let's unpack it.
We are looking at a fundamental rewiring of software economics.
Let's break down the technology first, and then we will look at the money. What is Agentic AI? Because right now, every company in the world is slapping the words artificial intelligence onto their earnings transcripts just to appease the algorithms.
Yeah, totally true.
What makes this different?
Agentic AI is a massive leap beyond the chatbots or the generative text prompts most people are familiar with. Synopsys isn't just bolting a chatbot onto their design software.
Right.
They are introducing autonomous robotic assistance agents that actually live inside the EDA environment.
What do these agents actually do?
Ghazi noted they have 20 major enterprise customers actively evaluating over 25 specialized AI agents right now. These agents handle incredibly complex, labor-intensive tasks like front-end verification, implementation, and analog flows.
Stop there. Explain an analog flow to me. What is the AI agent physically doing that a human used to do?
Okay, when you design a chip, especially the analog portions that deal with physical signals like radio waves or power management, the human engineer has to manually route the microscopic wires.
Manually?
Yeah. They have to ensure the timing of the electrical pulses is perfectly synchronized, which is called timing closure. They have to test thousands of different variations to optimize power consumption without generating too much heat.
That sounds exhausting.
Historically, an engineer would set up a design, run a simulation that might take 12 hours, look at the results the next morning, manually tweak a few wires, and run the simulation again. It takes months.
So what does the Agentic AI do?
The human engineer acts as the supervisor. They tell the AI agent, here are the parameters. I need this analog block to hit this power efficiency metric, and it has to fit within this specific physical footprint. The engineer hits go, and they literally walk away.
And the agent does the rest.
The AI agent autonomously takes over. It routes the wires, runs the simulation, analyzes the failure, learns from the mistake, tweaks the design, and runs it again.
Wow.
It does this autonomously, iterating thousands of times overnight, making engineering decisions at machine speed.
It's essentially automating the trial and error process of physics simulation.
Yes. It dramatically reduces the time it takes to achieve design closure. What used to take a team of engineers 6 months might now take 3 weeks.
Okay, the technological value is obvious. I mean, getting a custom AI chip to market 5 months faster is worth billions of dollars in competitive advantage to a company like Google or Amazon.
Billions.
But here is the multi-billion-dollar question for Synopsys investors. How do you charge for that?
And that is exactly what Ghazi addressed. And it is a revolutionary shift in enterprise software billing.
Let's hear it.
Historically, Synopsys, like almost all SaaS companies, charged a flat subscription fee for a user license. You pay a set amount per year, and one human engineer gets one seat to access the software.
But if an AI agent can autonomously do the manual labor of 10 engineers, 24 hours a day, 7 days a week, your human headcount goes down.
Right.
If Synopsys only charges by the human seat license, this AI tool is going to literally cannibalize their own revenue.
Precisely. If your customers need fewer human engineers because the AI is doing the work and you only bill based on human engineers, your revenue collapses.
Right.
So Synopsys is abandoning the flat fee human model and transitioning to a model Ghazi explicitly called subscription plus consumption.
I want to make sure I understand the mechanics of this. Can you give me an analogy for how this changes the billing relationship with the customer?
Sure. Think about the traditional SaaS model like a standard gym membership.
Yeah.
A semiconductor company pays Synopsys $10,000 a month. In exchange, their human engineer gets a key card to the gym. Once that engineer is inside, they can use the EDA software, the treadmills, the free weights, as much as they want for as many hours as they want. The price is flat.
Got it.
The subscription plus consumption model changes the fundamental rules of the gym. You still have to pay the $10,000 a month flat fee just to get the human engineer inside the building. That is the baseline subscription.
Right.
But when that engineer decides to deploy an autonomous AI agent to do the heavy lifting, when they tell the robot to run on the treadmill for them, a meter starts running.
So you pay the entry fee, but then you have to put a quarter in the machine every single time the AI agent performs a task or runs a compute cycle.
Exactly. You are paying for the human interface, but you are also paying a variable consumption-based toll for the autonomous work the AI performs.
That is brilliant. It completely bypasses the friction of trying to enforce massive, blunt price hikes on the core subscription, which always angers enterprise customers.
Oh.
Instead, Synopsys is saying, we're going to give you a tool that delivers exponentially more value. A tool that gets your chips to the foundry months faster. But we are going to take a microcut of every single automated action that tool takes.
And the hyperscalers will gladly pay it because the consumption cost of the AI agent is microscopic compared to the billions of dollars they save in accelerated time to market and reduced human engineering hours.
Wow.
This is how Elliott Management gets their monetization. This is how a 39.5% operating margin climbs to 45% or 50% over the next decade. As chips get more complex, the AI agents have to run more simulations and the consumption meter spins faster and faster.
The revenue scales automatically alongside the complexity of physics.
Exactly.
That is a staggering business model evolution. We have covered a massive amount of ground today. I mean, we have looked at the raw numbers, the gap adjustments, the multi-year backlog mechanic.
We covered a lot, yeah.
We've explored the shift from merchant silicon to custom AI processing, the explosive demand for PCIe 7.0 data plumbing, and the physics of 3D chip stacking that necessitated the ANSYS acquisition.
And the activist playbook.
Right, the Elliott Management activist playbook and the fundamental shift to consumption-based AI billing. It is time to draw a conclusion. Based on everything in this Q2 2026 earnings call, what is our definitive stance for you, the retail investor? Bullish or bearish?
We have to be strongly bullish. When you synthesize all of these data points, the fundamental thesis for Synopsys rests on 3 unshakable pillars.
Okay, walk me through the pillars. Pillar number 1.
Indispensability. The technological moat they have constructed is miles wide and miles deep. You literally cannot build a next-generation AI data center without interacting with their toll booth.
Right.
They own the EDA software required to design the neural logic. They own the IP blocks like PCIe 7.0 and UCIe required to connect the logic to the memory. And now, with the ANSYS integration, they own the multi-physics simulation required to ensure the 3D chip stacks don't physically destroy themselves.
They have captured the entire life cycle.
They have. Pillar number 2, Margin expansion.
Okay.
You have a company operating with massive multi-decade secular tailwinds driving top-line growth. But instead of getting lazy, they have an apex predator activist investor in the boardroom enforcing ruthless operational discipline.
Right, Elliott management.
The ANSYS cost synergies are hitting the income statement ahead of schedule. They are trimming real estate, optimizing headcount, and driving the operating margin past 41%.
Which is huge.
Accelerating revenue combined with contracting expenses is a mathematical recipe for explosive, sustained earnings per share growth.
And pillar number 3?
New revenue levers.
Yeah.
They are not just resting on their laurels and waiting for the overall semiconductor market to expand. The shift to subscription plus consumption pricing for agentic AI completely changes the calculus of their future cash flows.
Definitely.
Plus, they noted they are rolling out multi-physics fusion technology commercially in the second half of the year, which early trials show speeds up design closure by 3x. They have a clear, highly visible runway for extracting more value per customer over the next 5 to 10 years.
So to distill all of this down to actionable advice for you, if you currently hold SMPS in your portfolio, do not get shaken out by the noise.
Don't panic.
Do not look at a sequential decline in a lumpy enterprise backlog metric and assume the sky is falling. Understand the multi-year renewal cycles. The structural tailwinds of custom silicon development by the hyperscalers remain incredibly strong. Let the thesis play out.
And if you are considering initiating a position in the stock, you have to look past the accounting illusions. Don't overmodel the top line based on the $12.5 million ANSYS channel gross to net adjustment.
Right, ignore the mirage.
But do focus on the fundamental realities. The IP segment has definitively sequentially recovered from last year's slump, and their dominance in the architectural standards of 3D IC packaging is accelerating.
The transition from general-purpose computing to accelerated custom AI computing is the defining technological shift of our generation. And Synopsys is positioned at the exact, unavoidable bottleneck of that transition.
They really are.
We hope this deep dive brought some real clarity to the incredibly complex physics and financial mechanics driving this company, and provided actionable value to your investing process.
But before we wrap up, I want to leave you with one final, broader thought to chew on, something that extends far beyond Synopsys and impacts the rest of your portfolio.
Okay, what is it?
We just spent a significant amount of time detailing how Synopsys is successfully shifting its business model from flat software licenses to consumption-based AI agent billing.
Right.
They are proving that enterprise customers will accept paying a meter for autonomous work.
Yeah, they are.
If Synopsys proves this model works at scale and drives massive margin expansion, how long do you think it will be before every other legacy software company on the market tries to pull the exact same lever?
Oh, wow. That is a terrifying and fascinating thought.
Think about the other major enterprise SaaS holdings in your portfolio. Think about Salesforce or Adobe or Microsoft or ServiceNow.
All right.
For the last decade, we have lived in the era of the all-you-can-eat software buffet. You pay your subscription and you use the tool. But if every single software platform begins deploying specialized AI agents to automate tasks,
Whether that is drafting a marketing email or analyzing a spreadsheet or routing a customer service ticket.
exactly. Are we entering a new era where software costs scale infinitely alongside AI compute?
If that happens, the flat fee SaaS model as we know it is effectively dead. Enterprise software costs could skyrocket as every vendor takes a microtransaction cut of every automated task.
Exactly. It is a fundamental shift in unit economics that you need to keep a very close eye on as you review your broader tech holdings.
The gold rush is evolving.
It is. We aren't just watching companies sell the blueprints for the pickaxes anymore. We are watching them successfully figure out how to charge a micro royalty on every single swing of the axe.
Keep your eyes on the toll booth, because the tolls are quietly going up across the entire digital economy.